Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started.
Yeah, it is great to be here. We have a lot of ground to cover today.
We really do. It is Saturday, February 20th, 2026. And, if you are tuning in today, maybe you're grabbing a cup of coffee before the kids wake up, or maybe you're just prepping for the week ahead and feeling a little overwhelmed by the headlines.
Which is completely understandable.
Right. If that is you, you are in the right place. Our mission today is simple. We are going to cut through the noise. We aren't here to impress you with Wall Street jargon. We are here to make sense of a world that just feels like it's moving way faster than we can keep up with.
Absolutely. And based on recent analysis we've been doing over the last few weeks, there's a very specific theme emerging.
Yes, according to the research, three massive stories are bubbling up right now. First, we're going to talk about what they call cockroaches in the credit market. And no, that is not a figure of speech I just made up. It's a real theory about hidden dangers in the U.S. economy.
A very unsettling theory.
Very. Second, we are looking east to China, where the central bank is playing this really interesting game with its currency. It's less about putting up a stop sign and more about enforcing a speed limit.
That's a great way to look at it.
And finally, a story that honestly feels like a movie script. It involves the German chancellor, a dancing robot dog, and just a total reversal of everything we thought we knew about technology theft.
It really is a potent mix of topics today. And if I had to find the common thread tying a loan in London, a currency desk in Beijing, and a robot factory in Hangzhou together, it is connectivity.
Connectivity.
Yeah. We are seeing how a tremor in one corner, like, say, a specific type of software loan going bad, can ripple out and shake the foundation of a 401k or a pension fund right here at home. It's all about who really holds the leverage in this 2026 economy.
Who holds the leverage? That is the key phrase. Okay, let's unpack this first topic. We need to talk about private credit. I feel like this term gets thrown around at dinner parties by people trying to sound smart, but can we just level set for a second?
Yeah.
What exactly are we talking about here? Because it sounds like a bank loan, but it's not a bank loan.
Exactly. It is not a traditional bank loan.
Yeah.
Keep it really simple. Private credit is just when a non-bank institution lends money to a company.
Okay.
So instead of a mid-sized business walking into JP Morgan or Bank of America and asking for, say, $50 million, they go to a specialized investment firm or an asset manager.
Yeah.
And over the last decade, this has grown into a massive $2 trillion monster of a market.
$2 trillion. I mean, that is a lot of zeros. But looking at the data, it suggests the cracks are starting to show. Which brings us to the cockroach theory. I know Jamie Dimon mentioned this a while back, but why is it trending again now in February 2026?
Well, the cockroach theory is one of those visceral market metaphors. The idea is simple and honestly kind of gross.
Yeah.
If you walk into your kitchen at night, you flip on the light, and you see one cockroach scurrying across the floor, you know one thing for certain.
There isn't just one cockroach.
Exactly. There are hundreds behind the walls that you can't see.
So in finance terms, if one company that looked totally safe suddenly blows up, it means the whole neighborhood is probably infested.
Precisely. It implies systemic rot, not just bad luck for one guy. And unfortunately, based on recent analysis, we just saw a very big cockroach scurry out into the open over in London.
You're talking about Market Financial Solutions, MFS.
That is the one. They were a pretty significant lender based in London. But according to the data this week, they've gone into administration. Now, companies go bust all the time, right? But the reason why is what's scary here. The allegation is something called double pledging.
Double pledging. I mean, even the name sounds shady. Break that down for us.
Okay, imagine you own a house. You go to Bank A and say, hey, give me a mortgage, and if I can't pay you back, you can take my house. Bank A says, great, here's the money.
Makes sense.
Then you secretly go to Bank B, and you use that exact same house to get another loan. You don't tell them about Bank A. Both banks think they're safe because they both think they have the house as collateral.
But there's only one house. So if you go broke, one of those banks is getting absolutely nothing.
Exactly. And in the case of MFS, we aren't talking about a single-family home. We're talking about massive bridging loans. Major players like Barclays are looking at potential losses here. It completely shatters the myth that private credit is inherently safe just because it's backed by assets.
Right, because if the paperwork is fraudulent or if nobody checked if the asset was already pledged to someone else, that safety is just an illusion.
A total illusion.
But that's the institutional side, right? Big banks fighting over scraps. I was looking at the data regarding retail investors, regular people like you listening right now, and a firm called Blue Owl. This feels like the cockroach is moving from the wall into the living room. What is happening there?
This is exactly where the risk touches the average person. Blue Owl is a giant in the private credit space, and recently, reports surfaced that they had to tighten redemption rules for some of their retail funds. In plain English, they made it harder for regular investors to take their money out.
That is never a good sign. It kind of reminds me of being in a crowded theater. The movie's great, everyone is having a good time, but then someone smells smoke, and suddenly everyone tries to rush through that one small exit door at the exact same time.
That is the perfect analogy for what we call a liquidity mismatch.
Yeah.
These funds offer what they call semi-liquidity. They promise you can take your money out periodically, maybe once a quarter, but the stuff they own, those loans to companies, they are not liquid at all.
You can't just sell a 5-year business loan on a Tuesday afternoon because you need cash.
Right. So when too many investors get nervous and want out, the fund literally has to lock the doors.
Wow. Okay, so we have fraud with the double pledging, and we have liquidity issues. But here's where the research gets really surprising to me. Usually when we talk about credit risks in the U.S., we talk about commercial real estate or maybe energy. But the data points to a completely different culprit right now: software.
Yes. Software is the ticking time bomb.
I thought software was the golden child of the economy. You build it once, you sell it 1,000,000 times, you have 90% profit margins. Why is software suddenly the bad borrower?
Because the world has fundamentally changed.
Mm.
For 10 years, software was the safest bet because of recurring revenue. You sign up for a subscription, you pay $50 every month forever. Banks and private credit loved lending against that predictable cash flow.
Makes sense.
But according to recent analysis from Goldman Sachs in February 2026, there's a massive shift happening caused by artificial intelligence.
So AI is basically eating these software companies.
Think about it. A lot of enterprise software is basically just a fancy interface for a database or a tool to manage a simple workflow. If an AI agent can do that work for free, or if a new AI native startup can build the same tool in a weekend for a fraction of the cost, the old software company is dead in the water. They lose their competitive moat.
So let's say I'm a mid-sized American company paying $50,000 a year for some legacy accounting software. In 2026, I might just plug an AI agent into my bank feed and do it for $50 a month.
Exactly. And that legacy software company, they have a massive loan they took out 3 years ago, assuming you'd be a customer for life. Now you're gone. Their revenue collapses, but the debt remains. Goldman points out that private credit's exposure to enterprise software is over 15%. That is a lot of concentration in a sector being disrupted overnight.
And I saw a stat in the data warning of a tail risk scenario where default rates in this sector could hit 15%. That is huge.
It is massive. A 15% default rate is crisis-level stuff. It means a significant chunk of these loans might never get paid back because the companies literally cannot compete with the new AI reality.
So this begs the obvious question. If there is fraud, if the retail investors are trapped in these funds, and if the borrowers are being made obsolete by AI,
why hasn't the system crashed?
exactly. Why are we not seeing headlines about a 2008-style financial crisis right now?
That is the trillion-dollar question. And the answer is a concept analysts are calling dishwashing.
Dishwashing, like literally scrubbing plates in the sink.
It's a metaphor for how the market is handling the mess. Imagine a sink full of dirty dishes. That's the bad debt. Instead of draining the water and actually looking at the grime, they're just pouring more and more fresh water into the sink to dilute it. They are washing the bad loans with fresh money.
Okay, and where is this fresh water coming from?
From you. From pension funds and everyday 401ks.
Wait, so the smart money, the early investors, are looking for an exit, and my retirement fund is walking in the front door to provide the exit liquidity.
To an extent, yes. The data shows a massive flow of new money entering private credit from pension funds. And this isn't an accident. Do you remember the executive order from the White House back in August 2025?
Right, from President Trump. His administration wanted to open up more investment options for retirement accounts.
Correct. President Trump's executive order encouraged fiduciaries, the people managing your retirement money, to look at alternative investments to boost returns. And that policy is now bearing fruit. Billions of dollars are flowing in.
Wow.
It is buying time for the system. It keeps the market afloat and prevents a sudden crash, which is good in the short term, but it effectively transfers the risk from the private equity billionaires over to the teachers, firefighters, and everyday Americans holding those 401ks.
That's incredibly unnerving. It's definitely something we need to watch. If the cockroaches are hiding, we better hope the exterminator comes before the retirement funds get eaten.
Absolutely.
All right, let's pivot. We're going to leave the murky world of London lenders and U.S. software and head east. Let's talk about China and the yuan.
This is a totally different type of connectivity we're seeing here.
Usually when I see China and currency in the news, the story is always about manipulation. Keeping the currency cheap so they can sell us cheap EVs and TVs. But looking at the data from February 2026, it shows the exact opposite. The yuan is actually really strong right now, right?
Surprisingly strong. In 2025, the yuan rose about 4.4% against the US dollar. That is a massive move for a major global currency. And entering 2026, it just kept climbing.
So enter the People's Bank of China, the PBOC. They made some moves late this February. According to the research, there are two specific things they did. First, a risk reserve ratio cut, and second, something involving a fixing rate. Can we please translate that into plain English? What is the risk reserve ratio?
Sure. Let's imagine you are a Chinese company and you want to bet that the dollar will go up, or you just want to buy dollars to hold on to them. Previously, the PBOC basically said, fine, but if you want to buy dollars through a forward contract, you have to park 20% of that money with us as a deposit, just in case.
So it's like a mandatory surcharge or a deposit that ties up your cash. It just makes buying dollars artificially expensive.
Exactly. It strongly discourages people from selling yuan to buy dollars. But late in February, they slashed that ratio from 20% all the way down to 0%.
Zero. So they made it completely free to bet against their own currency.
Effectively, yes. They're making it cheaper for the market to buy dollars. This increases demand for dollars and helps weaken the yuan, or at least stops it from rising so aggressively.
Okay, and the second move, the fixing rate.
Every single morning, the PBOC sets a midpoint for the currency trading range. Lately, they have been setting that rate weaker than what the market actually expects. They are sending a clear signal to the world saying, we do not want our currency to get too strong too fast.
In our notes before the show, you used an analogy about a speed limit versus a stop sign. I thought that was really helpful to visualize this.
Yeah, think of the currency market as a car driving down a highway. The PBOC isn't putting up a stop sign. They aren't trying to force the car to slam on the brakes and turn around. They are just imposing a speed limit.
They're just tapping the brakes.
Right. They don't mind if the yuan is strong. A strong currency is actually good for them in some ways, like buying commodities. But they hate volatility. They do not want a one-way bet where everyone on Earth assumes the yuan is only ever going to go up.
Because if everyone bets one way, you get a bubble. And bubbles always burst.
Exactly.
But why now? Why is February 2026 the exact moment they decide to tap the brakes?
It boils down to two reasons. One is market mechanics and one is politics. On the market side, Chinese exporters, the companies making the solar panels and the electronics, have been hoarding dollars. They didn't want to convert them back to yuan because U.S. interest rates were higher. But as that rate gap narrows, there's a fear they might flood the market with selling, which would spike the yuan way too high, way too fast.
Ah, so the PBOC is trying to front-run that and smooth it out. And the politics.
We have the two sessions coming up in March. That is the massive political gathering in Beijing. The government wants everything to look calm, stable, and completely under control. They do not want wild market swings while the leadership is meeting.
So for you listening at home, the takeaway isn't to bet on the yuan crashing or soaring. It's to realize that the game being played here is managed stability.
Correct. Do not bet on a straight line when it comes to managed currencies.
All right, let's move to our final story. And I have to say, this one is my favorite because it just captures the year 2026 so perfectly. We have the German Chancellor Friedrich Merz visiting China.
A very high-stakes diplomatic visit.
And he visits a company called Unitree in Hangzhou. Now, for anyone who hasn't been scrolling social media lately, Unitree is the company that makes those viral robot dogs, right?
They do. And I should clarify, these aren't the clumsy, slow robots from 10 years ago. These things can run, jump, do backflips, and recover from a fall instantly. They are mass-produced, highly agile, advanced machines.
So the German chancellor is touring this cutting-edge factory. And usually these diplomatic tours are all smiles, handshakes, and photo ops. But according to the data, something really awkward happened.
It was very awkward. Reports suggest that at certain points in the tour, the German delegation and the accompanying journalists were stopped. There were strict no photography signs. They were deliberately kept away from specific production lines.
Let's just pause and appreciate the intense irony here. For 30 years, the dominant narrative in the US and Europe has been that Western companies go to China, and they are terrified. They are terrified. China is going to copy their blueprints, steal their tech, and rip off their intellectual property, hide the engine designs.
Right.
And now, in 2026, the German leader is in China, and they are the ones hiding their tech from us.
It is a complete 180-degree role reversal, and it is sending a chill down the spine of Western industry right now. The old narrative, Germany invents, China copies, is completely dead. In robotics, AI, and advanced manufacturing, China is now the one with the trade secrets worth protecting.
So they are actively protecting their intellectual property from the Germans.
They are. But it gets so much deeper than just hiding secrets on a factory tour. The real battle in 2026 isn't about outright thefts anymore. It's about global standards.
What does that mean exactly?
Well, look at the legal battles happening as we speak. The European Union is actually suing China at the World Trade Organization. Why? Because Chinese courts are aggressively setting global royalty rates for patents.
Okay, break that down for me. Royalty rates.
I imagine there is a specific foundational technology, say, a standard for how a robot leg communicates with a sensor. Everyone building a robot needs to use this standard. We call these standard essential patents.
Okay, I follow.
In the past, Western companies held all these patents and charged everyone else a premium to use them. Now, Chinese companies hold a massive chunk of these patents. And Chinese courts are ruling, hey, the fee to use this patent globally is very, very low.
Ah, I see. So they are effectively saying, our Chinese companies can use this tech incredibly cheaply, but that forces the global price down, which starves Western companies who rely on those royalties for their income.
Exactly. It devalues Western intellectual property while allowing Chinese manufacturers like Unitree to just flood the global market.
Right.
If Unitree can build a highly advanced robot dog for $2,000 because they control the supply chain and the patent standards, and a German competitor costs $20,000, the game is over.
It sounds like the German delegation realized they weren't there to teach China how to make cars or robots anymore. They were walking through that factory realizing they are fighting for survival in a market where China sets the price, the pace, and the rules.
That is exactly the realization. The core risk has shifted from they will steal our tech to they will outproduce us, out-innovate us, and force us to pay them royalties just to build our own machines.
Wow. So let's try to pull these three massive threads together for a minute. We started with the US and UK, where these cockroaches are hiding in the credit market. These are debts going bad because AI is destroying old business models faster than the loans can be paid back. Then we looked at China's currency, where the government is carefully tapping the brakes to keep things stable for their exporters. And finally, we end up in a robot factory, where the West is suddenly the one looking over the fence, wondering how we got left behind.
It's a lot to process for 1 week. But if I'm the listener today, the big takeaway is that in 2026, the real risks are hidden in the fine print.
The fine print.
Yes, the risk isn't just seeing the stock market go down on CNBC. It's in the details of a private loan agreement that naively assumes a legacy software company will still exist in 5 years despite AI. It's in the slight adjustment of a currency fixing rate in Beijing that completely changes how much money an American importer makes. Or it's in a no photography sign in a factory in Hangzhou that signals a fundamental change in who runs the future of technology.
It really challenges the assumptions we make every single day. We assume our 401k is perfectly safe just because it's diversified. We assume the dollar is the only game in town. We assume the West will always lead in innovation. And 2026 just seems to be the year those assumptions are getting a very serious stress test.
Absolutely. And critical thinking is your only real defense. Don't just look at the high yield of a fund. Look at the liquidity. Don't just look at a cool robotic gadget. Look at who actually owns the patent standard behind it.
I want to leave you all with a thought to chew on this weekend. We talked about how AI is creating those cockroaches by destroying old software companies, right? But at the exact same time, based on the research, we learned that everyday pension funds and 401ks are pouring money into these private credit markets to keep them afloat.
Yes, providing that fresh water.
So here is the provocative question for you to think about. If the cockroaches and private credit are hiding behind the promise of AI innovation, are we actively using our own retirement money to fund the very technology that is killing the companies we're lending to?
That is a paradox.
Are we funding the exterminator and the bug at the exact same time? Something to think about as you go about your weekend. That is all for today's deep dive. We really hope you feel a little smarter, a little more prepared, and a little more curious than you were 20 minutes ago.
Thanks for listening.
Don't forget to subscribe and hit that like button. We'll see you next time on Investment Insight.